Rising sea levels, prolonged heat waves, and severe weather events exert raw physical force on our hard industrial assets. When a storm floods a coastal refinery or drought halts production, the economic damage is immediate and measurable. Step inside a major financial institution, and that chaotic physical reality is replaced by something entirely different. Look at this corporate dashboard. We see a pristine net zero trajectory line, a glowing 1.5-degree score, and dropping carbon charts. But strip away the polished interface, and the certainty dissolves. The solid line shatters into wide confidence intervals, riddled with low-quality proxy indicators. In modern finance, greenwashing rarely looks like outright intentional fraud. It manifests as false precision, where highly estimated, methodologically fragile data is presented as exact environmental fact. To understand how environmental claims fail, we have to look past the marketing slogans. We have to investigate the structural uncertainties of how carbon is actually counted, assigned, and managed on a bank's balance sheet. For years, climate commitments were treated as an exercise in corporate public relations. A bank might announce a reduction in branch office paper usage, or purchase renewable energy for its headquarters, and call it climate leadership. That regulatory environment has shifted. Under frameworks like IFRS S2, the European Central Bank Guidelines, and the Financial Conduct Authority, climate positioning is no longer treated as voluntary signaling. Regulators now categorize it as an enforceable prudential and conduct risk. Under these new rules, greenwashing occurs when a sustainability claim does not clearly and fairly reflect the underlying reality of the product or the institution. If the label implies rigorous environmental screening, but the internal methodology is weak, it misleads the market. Because these claims are now regulated, a bank's environmental narrative carries the exact same legal, reputational, and supervisory exposure as its financial disclosures. The margin for exaggerated language has completely disappeared. To assess a financial institution's climate footprint, we first have to define its boundaries. Direct operational emissions, the energy used to power retail branches, run data centers, or fly employees to meetings, are statistically negligible in the context of the wider economy. Look at this boundary map. A bank's true footprint requires counting financed emissions, the carbon generated by borrowers it sustains with capital. The perimeter also includes facilitated emissions from off-balance sheet activities, like bond underwriting, which connects heavy-emitting sectors to necessary capital. A bank's actual climate profile is dictated by its capital allocation and credit underwriting choices, not the efficiency of its corporate headquarters. This creates a core accounting problem. Banks do not emit carbon from smokestacks, they intermediate capital. To measure their footprint, physical emissions must be mathematically attributed to their financial products. This PCAF flowchart reveals the attribution engine. A loan divided by enterprise value creates a fraction, multiplying the plant's physical emissions to define the bank's share. Since this relies on market capitalization, a stock downturn mathematically spikes the bank's emissions without any real-world pollution increase. Reported financed emissions often measure market linkage and valuation timing. They do not automatically represent actual physical decarbonization in the real economy. The attribution math assumes we know what the physical emissions actually are. We rarely do. Large public corporations report their emissions, but private companies and small enterprises, which make up vast portions of bank lending, often provide zero verified climate data. Banks use this estimation hierarchy. Top, verified data. Middle, physical proxies based on square footage. Bottom, economic proxies, multiplying revenue by generic sector averages. If a bank tweaks these proxies, estimated carbon drops instantly. They claim a reduction without changing any actual lending practices. When environmental progress is driven by accounting adjustments and proxy updates rather than actual portfolio transition, the institution has crossed the line into greenwashing. Investors and boards often seek simple, forward-looking indicators to summarize a climate strategy. The market responded by creating the 1.5-degree portfolio temperature score. Disassembling this score reveals model outputs, not physical temperatures. It relies on estimated baselines, subjective sector pathways, and unverified client CapEx promises. If a client announces a transition target but fails to fund it, that fragile assumption jams the bank's entire alignment model. A bank can improve its temperature score overnight simply by selling off a high-emitting loan. The metric looks pristine. But the underlying physical asset is still operating and still polluting. It is just funded by someone else. The optics improve, the outcome does not. Forward-looking metrics are structured inferences made under conditions of deep uncertainty. Presenting these projections to investors as guaranteed physical facts creates a narrative of certainty that the underlying evidence cannot support. Up to this point, we have looked at how banks measure their impact on the climate, but supervisors are equally concerned with how the climate impacts the bank's bottom line. This flowchart maps the transmission channels. Macro-environmental events become micro-financial losses through three specific pillars: physical risk, transition risk, and liability risk. All three point directly toward a bank's expected credit loss and probability of default. Physical risk damages hard assets, destroying the value of a bank's collateral. Transition risk occurs when carbon taxes or abrupt policy shifts force sudden margin compression on borrowers, driving up their probability of default. Liability risk targets the institution directly. Misleading product labels, weak proxy data, and exaggerated net zero claims invite litigation, regulatory fines, and defense costs, creating a direct drain on capital reserves. Greenwashing is a failure of risk management. Relying on false precision misprices credit risk at the point of origination, leaving the bank's capital reserves highly vulnerable to sudden shocks. The disconnect between marketing labels and underlying methodology has drawn heavy supervisory scrutiny. Climate reporting has transitioned from elective marketing into the machinery of financial risk management. Regulators and the market now recognize that capital allocation is the engine driving the climate transition. Because financial institutions hold the levers to that capital, they are now required to build strict anti-greenwashing control architectures. Financial institutions must stop hiding behind false precision. They have to map their data gaps, disclose their proxies, and begin treating climate data with the exact same evidentiary rigor, auditability, and strategic discipline as traditional financial accounting.